talk button.
Good afternoon.
Now we're
Good afternoon. The hearing will come to order on how other countries have used tax reform to help their companies compete in the global market. And good afternoon. I want to thank everyone for joining us today for the next in our series of hearings on comprehensive tax reform. Today's hearing will examine international tax rules in various countries and identify best practices that might be applied here in the United States. The hearing will explore policy choices that must be considered to create a structure that maximizes competitiveness and job creation while also appropriately protecting the U.S. tax base. This is the second hearing the committee has convened on international tax. During the first hearing, we looked at how America's high statutory corporate tax rate, the ever-increasing complexity of the tax code, and our worldwide system of taxation impairs our competitiveness in the global economy. And during that hearing, a number of witnesses encouraged the committee to benchmark our efforts on international tax reform against what other countries, especially our major trading partners, have done recently in this area. So many of our major trading partners across the globe have already reformed their tax laws in ways they believe help their companies expand their own global operations and support good-paying jobs within their own borders. Some of these countries have improved upon the rules they've had in place for decades, while others have recently enacted major reforms with global competitiveness in mind. Through the testimony of the panel assembled here today, we will discuss the approaches developed and implemented by our global competitors. We hope to learn what influences led other countries to move toward a territorial system and other related corporate tax reforms, such as a lower corporate rate. We also expect to hear some details about the process these countries undertook in developing their reforms, as well as lessons learned and other outstanding issues these countries are encountering with their international tax systems. Finally, in hopes of crafting a system that is uniquely American, we will begin to focus on what a more territorial U.S. tax system would look like, including key design options to consider for the United States. There's no doubt that the global marketplace is changing. Today, it doesn't even slightly resemble the marketplace that America once dominated. As our world economy changes, America must also change and adapt. That begins with transforming our tax code so that America can be a more vibrant competitor abroad and a more attractive place to invest and create the jobs we need here at home. As this committee re-examines the tax code and pursues comprehensive tax reform, we are grateful for the insight provided by our witnesses. Thank you all for being here. I will now yield to Ranking Member Levin for his opening statement.
Thank you, Mr. Chairman, and welcome to all of you. In this committee's last hearing on tax reform 2 weeks ago, we heard testimony from U.S.-based multinational corporations regarding what they believe corporate tax reform should look like. Their testimony illustrated, I think, the importance, the complexity, and the controversial nature of these issues. They indicated that they would prefer sharply lower rates and a territorial system. At the same time, they rejected the notion of a one-time repatriation holiday, acknowledged the need for reform to be at least revenue neutral, and suggested that the U.S. consider a value-added tax to make up the revenue that would be lost by cutting corporate taxes. The testimony from the last hearing bears on today's hearing, because U.S. multinational corporations, by and large, often describe their desire for a European-style territorial system, or a tax system that is similar to that of our major trading partners. Today, I hope we will continue to explore exactly what such statements mean. If we are going to compare our tax system to our trading partners, it's appropriate to consider the broader context of their corporate tax systems. To say simply that we want to adopt certain territorial features and low statutory rates offered by other countries' tax systems is somewhat like going out to shop for a car and saying, "I'd like to have a Corvette engine," without worrying about anything else. That engine comes with a number of trade-offs. In the case of a Corvette, when you get that engine, you know not to expect wonderful gas mileage, 4 doors, room for children, and low-cost insurance. You know that having that powerful V8 will mean compromising on some other things. These compromises and trade-offs may not be appropriate for everyone. As we consider the corporate tax systems of other countries, it's important that we pay close attention to the compromises and the trade-offs that they might entail. What kinds of anti-abuse rules did countries with territorial systems have to adopt to stem erosion of their corporate tax base? What do choices about a corporate tax system mean for other countries' individual tax systems and the necessity of finding other revenue sources, such as value-added tax? What is the broader economic context in which these choices were made? How much do these other countries invest in economic fundamentals, such as education and infrastructure? How does their revenue collection relate to these important investments? Last, but perhaps most importantly, we should consider the basic differences between our economy and the economies of our trading partners. Our European trading partners, for instance, operate under an EU rules that constrain their options for corporate taxation. It's also the case that the U.S. remains the largest economy in the world, and we remain the world leader in innovation. How much do we need to follow in the international tax arena? How much do we need to lead? With these questions in mind, my Democratic colleagues and I look forward to hearing the witnesses' testimony today. Thank you.
Thank you very much, Mr. Levin. We're pleased to welcome our panel of experts, all of whom either have extensive experience as law or accounting practitioners in countries that have moved to more territorial-based tax systems or have spent time studying such systems in the halls of academia. First, I'd like to welcome and introduce Gary M. Thomas, a partner at White & Case in Tokyo, Japan. Mr. Thomas has worked in Japan for over 25 years and is a licensed Japanese tax attorney, fully qualified to practice before the Japanese National Tax Agency and the National Tax Tribunal. It's my understanding that he's the only U.S. attorney with such qualifications. We know that it has been an extraordinarily challenging time for Japan and all its residents over these past several months, so we're especially grateful for your willingness to appear before us today. Second, we'll hear from Frank Schoen, a partner at Ernst & Young and originally from the Netherlands. Mr. Schoen heads Ernst & Young's Dutch desk as part of the firm's international tax services practice in Chicago and has spent more than 22 years of experience in serving multinational clients. And third, we welcome Steve Edge, a partner at Slaughter & May in London. A large part of Mr. Edge's practice involves advising multinational corporations on cross-border transactions, and we look forward to him sharing his expertise about the UK tax system. And fourth, we'll hear from Jörg Menger, a partner at Ernst & Young and the head of the German tax desk of the firm's international tax services practice in New York. Before joining the international tax services practice, Mr. Menger worked in the National Ernst & Young office in Germany. And finally, we'll hear from Reuven Aviona, the Irwin I. Cohn Professor of Law at the University of Michigan Law School in Ann Arbor. Professor Aviona is a familiar face here at the Ways and Means Committee, having testified before us several times, and we welcome you back this afternoon. Thank you all again for your time today. The committee has received each of your written statements, and they'll be made part of the formal hearing record. Each of you will be recognized for 5 minutes for your oral remarks, and Mr. Thomas will begin with you. Votes have been called on the floor. There will be 2 votes. I was hopeful we could get through 2 of your 5-minute oral testimonies before we broke for the vote. So, Mr. Thomas, you have 5 minutes.
Thank you, Chairman Camp, Ranking Member Levin, and members of the committee. My name is Gary Thomas. As indicated, I'm with White & Case in Tokyo. I appear before you today on my own behalf and not on behalf of my firm or any firm client. It is a privilege to have been invited here today to testify on how Japan has used international tax reform to assist its companies to compete in the global market, to revitalize Japan's economy by encouraging the repatriation of foreign profits to Japan, and to enhance employment opportunities in Japan. Prior to 2009, Japan's international tax system bore a remarkable resemblance to that of the United States. Japan imposed its corporate taxes on a global basis, including taxing dividends from foreign subsidiaries, while avoiding double tax by means of a foreign tax credit. Japan deferred taxation of profits of foreign subsidiaries until repatriation, but restricted deferral for profits of CFCs operating in low-tax countries unless an active business exception applied. The similarity with the U.S. international tax regime was not surprising because for the past 50 years, the U.S. tax system has been Japan's model. However, on April 1, 2009, Japan moved to a territorial tax regime by adopting a foreign dividend exemption system, pursuant to which 95% of the dividends from qualified foreign subsidiaries are exempted from Japanese national and local corporate income taxes. At the same time, Japan abolished its indirect foreign tax credit system. Why did this substantial change occur? There were a number of key reasons. First, the Japanese government concluded that it was vital to encourage the repatriation of profits of foreign subsidiaries in order to assist in revitalizing Japan's economy. There had been a significant increase in profits retained overseas by foreign subsidiaries, but Japan's tax regime resulted in the imposition of additional corporate taxes in Japan upon repatriation of those profits, thereby creating a clear disincentive to repatriate. It was felt that a failure to repatriate these profits to Japan raised the risk that R&D activities and jobs would be shifted overseas. Second, the policymakers recognized that maintaining the competitiveness of Japan's multinational enterprises in the global marketplace would ultimately lead to additional investments and job creation within Japan and to the promotion of Japan's economy, and that eliminating bias and capital flows within corporate groups was critical for this purpose. Third, the government was deeply concerned about the increasing compliance burdens imposed by the indirect foreign tax credit system and the overall international tax regime. It is noteworthy that in adopting the foreign dividend exemption system, Japan explicitly rejected capital export neutrality as a key guiding principle in the new global business environment. Although this principle had been imported from the U.S. 50 years ago, the position of the foreign tax credit approach based upon capital export neutrality was characterized as having declined, while the era of the United States as the dominant capital exporting in the world was ending. In considering this new tax regime, Japan did not ignore potential downsides. In particular, the government was worried about the possible hollowing out of Japan's economy and shifting of jobs overseas. However, the government concluded that the adoption of the foreign dividend exemption system itself would not unduly influence corporate decisions as to whether to establish or move operations overseas. Nevertheless, the Japanese government implemented and continues to study a number of design features in order to cope with the risk of shifting of profits, assets, and jobs overseas. These include, for example, denying deferral for passive income of CFCs. There's also been a proposed reduction of corporate tax rates in Japan. In addition, the government continues to evaluate potential measures to reduce the risk of outbound transfers of intangible property while encouraging R&D and related job growth in Japan. For example, it is reported that potential relief for at least some types of royalty income is being closely reviewed. In closing, as a tax practitioner working in Asia, I've seen firsthand how nimbly America's competitors can operate within their territorial tax systems at the same time that U.S. corporations struggle to deal with the very complicated and burdensome U.S. worldwide tax regime. Your review of the U.S. tax rules, therefore, is extremely important. Thank you.
Thank you very much, Mr. Thomas. We have less than 5 minutes for this vote, so we're going to recess now, and we'll return and hear from the rest of our witnesses after this series of 2 votes on the floor. Thank you. All right, the hearing will resume. Mr. Schoen, you have 5 minutes, and your full statement will be made part of the record. Welcome.
Mr. Chairman, Mr. Ranking Member, and other members of this distinguished committee, it is an honor to participate in these hearings on international tax reform. I would like to thank you for the invitation to appear before you today to provide information on key international elements of the Netherlands corporate income tax system. I am Frank Schoon, a Netherlands tax partner with Ernst & Young, based in Chicago. I appear before you today on my own behalf and not on behalf of my firm or any client. Corporate income tax is imposed in the Netherlands on the worldwide profits of resident entities and on the income derived from certain sources within the Netherlands of non-resident entities, with provisions to prevent double taxation. The provision used in the Netherlands to prevent double taxation is a dividend or a participation exemption, as well as a foreign branch exemption. This is generally referred to as a form of a territorial tax system. As of January 1, 2011, the Dutch corporate income tax rate is 25%. Over the last 3 decades, the corporate income tax rates have decreased from 45 to 48% in the early 80s to the current rate. From parliamentary history, it can be seen that the motivation for this decrease generally was to lower the tax burden on companies, to stimulate investment and to create jobs, as well as to align with developments in other jurisdictions. One of the pillars of the Dutch corporate income tax system is the participation exemption regime, which aims to prevent double taxation of business profits at different corporate levels in both a foreign and a domestic context. The origins of the participation exemption regime go back to 1893. 100 years later, in 1992, the Dutch State Secretary for Finance stated during parliamentary proceedings that the exemption method, as provided under the Dutch corporate income tax system, is still the most suitable system for the Netherlands, considering its many international relations and its open economy. The participation exemption regime fully exempts income, such as dividends and other profit distributions, currency gains or losses, and capital gains or capital losses, realized with respect to a qualifying interest in a subsidiary. To qualify for the participation exemption, an ownership test and a motive test must generally be satisfied. Under the ownership test, the taxpayer is required to hold at least 5% of the subsidiary. Under the motive test, the interest in the subsidiary cannot be held as a portfolio investment. The motive test is generally satisfied if the shares in the subsidiary are not held merely for a return that may be expected from normal asset management. If the motive test is not met, the participation exemption could still apply if either an asset test or a subject to tax test is met. Under the current Dutch rules, expenses related to interests that qualify for the participation exemption are deductible, and several anti-abuse measures apply to limit deductions in specified circumstances. If a Dutch tax resident has a foreign permanent establishment, the income, both positive and negative, of the foreign branch will directly be included in the worldwide income of the Dutch tax resident. As a result, foreign branch losses are deductible, albeit subject to recapture. Foreign branch income is generally exempt. The Dutch government is currently considering moving to a full territorial tax system for foreign branch income. This would mean that foreign branch losses are not deductible and income would continue to be exempt. Other foreign source income, like interest and royalties, is in principle subject to the current statutory rate of 25%. However, net earnings from qualifying intellectual property, such as royalties for example, may effectively be taxed at a rate of 5% under the so-called innovation box regime. This regime was first introduced in 2007 to cover patents and has been expanded to cover other forms of intangible property. It was intended to stimulate development of technology, innovation, and employment in the Netherlands. There are no special provisions in Dutch law for controlled foreign companies. In the Dutch tax system I have described, the relevant question therefore is whether or not the participation exemption or the branch exemption applies, which along with the anti-abuse rules address the issue of mobile and passive foreign income. Thank you very much. I would be happy to answer any questions.
Thank you very much. Mr. Edge, you have 5 minutes, and your full statement will be part of the record as well.
Thank you. Chairman Camp, Ranking Member, Levin, members of the committee, I too am pleased to be here today, and I hope that I can help you in your deliberations. First of all, let me apologise for the length of my testimony. As you'll see, we've been on a long journey in the UK, and I thought it would be interesting for you to see some of the very open revenue consultations that there have been, which tell the full story in what the revenue in recent years have been calling a direction of travel. As I acknowledge in my paper, tax is an important business consideration, but it's not the most important. Logically, one might say that the best tax rate for a corporate tax lawyer is 0, but we know that that's not practical politics. This is not, as some people have suggested, a race to the bottom. It's a question of finding the right balance between the tax rate that is fair for business and will enable it to compete, and that is fair to the society that is imposing that tax. As the UK has gone along its direction of travel, I think 3 pressures have emerged, and I deal with those in my testimony. The first is obviously government pressure. Government needs to raise funding to provide the infrastructure that business needs in which to operate and to provide all the facilities that its people need. It also needs to be cognizant of the fact that tax can be a great disincentive to investment. Secondly, industry, a huge amount of pressure, as you'll see from my paper, the 2007 consultative document in which the government sought to extend the scope of our CFC rules so that they resembled what I remember of your Subpart F rules in the early 80s, taxing offshore passive income regardless, resulted in many UK companies saying, well, if that is the way the UK system is going to be, we will leave the UK. The UK does not have and cannot have anti-inversion rules. And as I explain in my testimony, the effective tax rate is absolutely key if a multinational is going to compete and is going to continue to grow. Thirdly, we have the pressures that are created by the EU freedoms, which say that if you are within the EU, your laws can't distinguish between an investment that you might make elsewhere in the UK, buying shares in a company in the north of England, and an investment that you might make in a Spanish, French, German company. So if you have a 100% domestic exclusion on dividends, you must have it if a dividend is coming in from elsewhere in the EU. And equally, if you don't have CFC rules within your domestic regime, which would be rather stupid, again, you can't have them internationally. But as I say in my paper, although you could look at it and you could say that the EU rules forced us in the direction of conforming to an exemption system, that I don't think was the main driver. The main driver, as the consultation showed for where we've got to now, which is an exemption system with no interest allocation and severely pared down CFC rules compared with what we've had in the past, is that there is perceived to be an identity of interests between government in maintaining our national champions. Multinationals are perceived to be good things and to contribute things to the UK which we would prefer to have. Secondly, the government has been brave and said that we should not have a tax system that distorts good business decisions. If people want to invest somewhere else, they should be free to do so, and the UK tax system should not then take away an overseas tax advantage that is part of the total picture as to why someone invests overseas. And we shouldn't create penalties when somebody repatriates cash, which might be a barrier to investment in the UK. Of course, industry in its desire to achieve an effective tax rate that's low has to be conscious of its obligations. There's more pressure now in the UK on social responsibility in tax, and base erosion has been a key part of this process. As I say in my testimony, the UK decided not to have interest allocation. That decision, I think, could have gone either way and will be kept under review. The CFC rules, I think, are part of our territorial system now. We're trying to be sensible on those and only tax income within a CFC if there is clear evidence of avoidance or diversion. And in order to make the UK comparatively a more attractive place to invest, we have lowered the domestic tax rate, which is targeted to come down to a 23% rate by the end of this Parliament. So we're on a long journey. I hope we're proceeding to a successful conclusion. Thank you.
Thank you very much. Thank you for your testimony. Mr. Manger, you also have 5 minutes, and your written testimony will be part of the record as well.
Mr. Chairman, Mr. Ranking Member, other members of this distinguished committee, thank you for your honor to participate in these hearings of international tax reform. I'm Jörg Menger, an international partner of the German firm of Ernst & Young, currently on assignment in New York. I appear before you today on my own behalf, not on behalf of my firm or any client. The purpose of this statement is to provide a brief overview over the German corporate tax system, in particular the tax treatment of foreign source income. German tax policymakers have long focused on the implementation of a system of foreign source taxation which is governed by the principle of capital import neutrality, which is aimed to ensure that German companies are able to compete in foreign markets against local companies. The German corporate tax rate, as income tax, corporate income taxes and trade taxes, the current combined average tax rate is slightly below 30%. The current tax rate reflects a series of reforms which has reduced the corporate tax rate from as high as 65%. To avoid a double taxation on corporate earnings distributed within a chain of corporations, the German corporate tax rate employs an exemption system on dividends distributed from one corporation to another corporation. Generally, 95% of any dividends received by a corporation are tax exempt, thus only 5% of the dividend income is included in the taxable income. The tax policy rationale for the 5% income inclusion is to act as a compensating offset for the deduction of business expenses which are directly related to the exempt dividend income. The implementation of the 5% inclusion rule ended a constant conflict between the German taxpayer and the German tax authorities with regard to the interest deduction. A brief overview of the history of the international German tax system should provide an insight into the current tax policy. Beginning in the 50s, dividends distributed by foreign corporations to German corporations were exempt from taxation pursuant to the tax treaty provisions. This 100% exemption, combined with a rule that disallowed deductions on certain expenses which were directly related to the shares owned in the distributing company, were determined using the tracing approach. Since 2001, the treaty-based rule on dividend and capital gain exemption was replaced by a 95% exemption, and this applies both to foreign and domestic shares. Germany has controlled foreign corporation rules which subject undistributed income of foreign controlled companies to a full German corporate and trade tax, but only if such income is both passive in nature and low taxed. Moreover, the CFC rules do not apply to EU subsidiaries if the subsidiary carries on an own business activity. In summary, Germany has incorporated its territorial tax system in the tax treaty network and the tax code with special rules for low tax passive income. This approach was guided by the principle of capital import neutrality and simplicity. Thank you, and I'm happy to answer any questions.
Thank you. Mr. Avione, you have 5 minutes as well, and your full statement will be part of the record.
Thank you, Chairman Camp and Ranking Member 11, members of the committee, for inviting me to testify before you on this important topic. I will make 5 points. The first one is that despite what you may have heard, the issue before us is not really about territoriality versus worldwide taxation, because as the witnesses before me have clarified, in fact, all of us have a mixed system in which we tax some income of our residents, corporations, overseas currently under the CFC rules or other anti-abuse provisions, and other income is not. This is really not about worldwide versus territorial at all. This is about whether we will tax dividends that are sent back from CFCs, from income that is not subject to Subpart F, when it arrives to our shores, and that is the various participation exemptions that have been described. Now, that particular narrow issue, in my opinion, has nothing to do with competitiveness. Competitiveness, as Mr. Edge, for example, has mentioned, is determined to the extent that it's determined by taxes at all, and there are other more important topics, but to the extent it's determined by taxes, it's determined by the overall effective tax rate that is borne by a multinational from a particular country, or you could say maybe sometimes by the effective tax rate on foreign source income on particular projects. It's not determined about the question of whether you tax dividends when they're sent back, because that tax basically is never paid. The dividends are not repatriated if there is an additional tax to be paid on them, so how can that affect competitiveness? The issue of competitiveness has to do with the overall tax rate, not with the tax on dividends. Second point is that there is an issue with sending dividends back, and that is the issue of the trapped earning phenomenon. American multinationals don't repatriate unless there is a foreign tax credit, and a lot of their earnings overseas are subject to a low tax rate, so then they don't repatriate. But that particular issue, which is a real issue, has another much simpler solution, which I think alleviates the need to deal with a lot of the other problems that I will talk about. And that solution is that we should tax those income currently as they are earned. That is, we should repeal deferral. Now, I think that that is only feasible if we significantly reduce our rate to prevent us from being anti-competitive. But nevertheless, I think that that will, for example, enable us not to have to worry about transfer pricing. It will enable us not to have to worry about the endless characterization of Subpart F, etc. So if trapped income is the real problem, then I think that is another solution. Now, adopting an exemption for dividends without doing anything about the potential for profit shifting is really problematic. Currently, the main disincentive for American multinationals to put their profits overseas is because they know that they will not be able to bring them back without paying tax. That is the trapped income phenomenon. If we abolish that, that is, if we stop taxing dividends, then there will be no disincentive to further shift profits overseas. And here I think if you listen carefully, you could see that, in fact, the anti-abuse and CFC rules of our trading partners, not just those that are represented at the table, but other ones as well, are significantly different from our Subpart F, because they all take into account explicitly the effective tax rate in the source jurisdiction, that is where the income is earned. And if the income is passive and is subject to low taxation at source, then that triggers Subpart F, that is the CFC rules. Of course, our Subpart F doesn't work that way, as you all know. It has nothing to do with the effective tax rate in the source jurisdiction in almost all cases, and it enables freely to shift income from one CFC to another without triggering Subpart F, so that if income, for example, is shifted to one of those 4 countries, which has a real corporate income tax rate, our Subpart F then enables you to shift the income again to a 3rd country which has no income tax whatsoever and leave it there as, quote, active income without, or as non-existent income if you are going to disregard transfers from one CFC to another without triggering Subpart F inclusions. And that, I think, is what makes our system particularly porous and subject to income shift abuse, and that is why we should be really careful about this. Now, the 4th point is that this is a revenue loser. It is a revenue loser under some circumstances, specifically if we don't adopt any limitation on expense deductibility, but that seems to be the direction in which we're going, in which case it's a revenue loser and we can't afford it. And then finally, I think the comparison that is being launched today ignores, as Ranking Member Levin mentioned in his opening remarks, other differences between our system and the overall economy of the countries that we're being compared to that I think are also relevant, and I'll be happy to answer questions about them. Thank you very much.
Well, thank you. Thank you very much. I would just like to point out a territorial system or international tax system does not need to lose revenue. I mean, it could be designed in such a way that it's revenue neutral. That would be another sort of discussion. But I did have a question, particularly for Mr. Thomas, and I think anyone who wanted to weigh in, all 4 of you who are really sort of talking about particular countries, what were some of the underlying reasons that I think we've seen some dramatic changes in international tax law and tax reform? Was it about competing abroad? Was it making their workers more competitive? What were some of the underlying reasons? And if you want to start, Mr. Thomas, we can just go down the row.
Thank you. I like to use a sports analogy. An American football team on the field playing against a UK soccer team. And the American football team goes on the field, all sorts of complex rules, penalties. They have to huddle. They have to determine how they could move the ball forward within all those complex rules. At the same time, the soccer team is out running around the entire field, reacting on a second-by-second basis is what's happening everywhere, and simply can be much more flexible. My sense is that Japan looked around, and they did do benchmarking. They looked at other countries, and they came to the conclusion that the rest of the world is playing soccer, and that Japan should play soccer as well in order to compete effectively in each of the jurisdictions that they are competing with companies from France, Germany, the UK, and particularly throughout Asia, where there are many emerging countries growing rapidly, many of those countries offering various tax incentives for business that the Japanese companies want to take advantage of.
In the Netherlands, it is not a recent development, but it has been reviewed over time, and I quoted the statement by the State Secretary of the Ministry for Finance in the 90s. The idea is indeed capital import neutrality, to be able to compete locally, and also to recognize the sovereignty of third countries.
Thank you. Mr. Edge?
For me in the UK, I think competitiveness is at the heart of it. When I talk to my UK-based multinational clients, they can achieve low effective tax rates, but only, as someone said to me, by running very hard and working very hard. And if they look at their peer groups around the rest of Europe and in the US, they will find that effective tax rates at a global level are lower. And that does make it very difficult for you to compete, particularly if you're looking to acquire other companies and grow. And as a symptom of that, in 2007, when the last Labour government was looking to extend the CFC rules, that was seen as having a direct effect on effective tax rates, and it resulted not in a mass exodus, a number of small companies left, but the bigger companies in the UK, and a number of them said this publicly, said, we like the UK for everything else it's got to offer. If the tax system is going to make us uncompetitive, we've got to work with government and change it. So it's competitiveness that drives it.
All right. Mr. Menger?
Yeah, Germany didn't change the system. They have that exemption system then since after World War II, and the German system is driven by the capital import neutrality in order to compete in the foreign markets.
All right, thank you. And Mr. Thomas, to what extent, as you talked about these rules, football versus soccer, what rules, to what extent did corporate tax rates play in the decision to make changes in Japan, as well as the double taxation of foreign source profits? What were the factors that really sort of drove that, or the rules as you called them?
Well, I think there were quite a number of factors. The Japan authorities were concerned about the complexity of the tax system, the resources that Japanese companies were having to devote toward complying with the tax laws. In fact, I hold here in one hand the entire Japanese national and local corporate tax laws, income tax law, all the tax laws and regulations in one hand. They prefer simplicity. They prefer not having to have armies of tax lawyers figure out what the laws mean and comply with them. I think that they definitely wanted to be able to take advantage of the various types of tax incentives that are granted in other countries, particularly in Asia. and they felt they could do this effectively really only by adopting a territorial system.
Mr. Schoen, the Netherlands has had, I know you call it a worldwide system, but it is in effect a territorial system, or at least how we look at it. So I just wanted to make sure you're using the same terminology. And you've had it for 100 years. What are some of the structural issues that continues to maintain that sort of tax policy that you look at? What are some of the reasons that that's worked for the Netherlands, I guess, is a better way to put it?
The reasons that it has worked, I think, as I referred to earlier, it did allow Dutch companies to grow, Dutch multinationals to grow in a way that was acceptable and preferred by the Dutch government. Excuse me. So I think that's the most important aspect, actually.
All right.
The stimulation that created.
And Mr. Edge, I think you mentioned that corporate rates did play a significant role in the UK. Were there other factors as well?
EU pressures, which of course affect the other two European countries here, have come into it. But interestingly, I think the revenue haven't yet admitted or resolved that they've been losing the litigation on that. So they've been trying to work within it. No, I think it's been at the heart of the fact that the UK, with a maritime tradition and a mercantile tradition, has wanted to have a competitive system to attract people to the UK. I make the point in my testimony, I don't know whether members of the committee will remember that when we put our tax rate up to 52% in 1972, we had to take immediate action so that US companies who were investing in the UK did not suffer that 52% rate, but could, through the double tax treaty that was negotiated, get a tax refund in the UK to bring their tax down. I think the US rate then was 40%. Others of you may have noticed early in my career, when UK tax rates were somewhat eye-watering 83% and 98% for individuals, and as I say, 52% for corporations, spent quite a bit of time working on Northern Ireland investments, where they looked rather jealously across the border at then the Irish incentives, and Northern Ireland got its fair share of industrial basket cases. Interestingly, the government in the last budget has announced that it's proposing something rather radical, which is a lower tax rate for Northern Ireland as part of the UK, simply so that with its identical geographic position, economic advantages to Southern Ireland, it can compete evenly across the border. So even the low UK rate is thought to be uncompetitive on the island of Ireland.
Okay, thank you. Mr. Levin may inquire.
Yeah, thank you very much. And I think it's very useful to have this hearing and to really scratch beneath the surface and try to go beyond labels, because I think as we read the testimony, the systems, really all of them are mixed in some degree, and you don't have either or. We pulled out, for example, provisions that show the mixed nature. Just to review a few of them quickly. For Japan, there are major transfer pricing guidelines. Also, there are certain provisions relating to denial of deferral on certain types of passive income. And also there are certain provisions relating to royalty income. And also, I'm not sure it was mentioned, the present system subjects 5% to taxation. That's a system used in other countries. In terms of the Netherlands, as we extracted the provisions there that I think show the mixed nature, some of them are fairly complicated under, for example, the ownership test and that interest in a subsidiary cannot be held as a portfolio investment. And then you have a lot of other anti-abuse provisions and provisions relating to foreign branches. And it's interesting on interest and royalties that they have a higher tax except where there's an innovation box provision, which I think again shows the mixed nature of this. With Germany, which I guess has an older system with 95%, also you have exemptions relating to dividends, also to branches that are in a non-treaty jurisdiction. So there's a differential between investments or operations by a corporation one place or another, depending where there's a tax treaty. Also differentials as to whether income is passive or not, and also some major transfer pricing provisions that I guess reflect the OECD. And so I think as you go through this, the Netherlands and the UK, you see that what we need to do is to kind of pierce through the surface here and also try to go beyond either or propositions, look at what the realities are here and overseas, and to see, I think, a primary standard has to relate to our competitiveness. My plea is that we all take the time, and I think your testimony is indeed useful, to look at the complexities in each of these systems, because they're not just simple. You held up the code, and I didn't ask you how many pages they are, but it's more than a few, and not as many as we have here. And I think also we should take seriously the testimony that was given by Mr. Avillona in terms of what is the reality within each of these territorial systems and how they relate in reality to what we have today. And I think we'll see the complexity because, Professor, you suggest the elimination of deferral. That in itself is very complex and controversial. And as I said a few weeks ago when Emma Houghton and I many years ago sat down for a couple of days on a bipartisan basis to look at our international tax system, we came up with some ideas, some of which were incorporated in legislation. But when we got to deferral, we came to a stop because it was difficult to find a strong basis to proceed. So thank you very, very much for your testimony.
Mr. Herger is recognized.
Thank you, Mr. Chairman. Critics of a territorial tax system often argue that it will result in companies shipping jobs overseas. Based on your experiences and observations, does adopting a territorial tax system result in jobs being shipped overseas? And I'd like to ask each of our witnesses that represent other countries, beginning with you, Mr. Thomas.
Thank you. That's certainly a very important question, and as I indicated in my testimony, the Japanese government was concerned. They consulted very closely with business. They tried to learn from business what factors are involved in deciding to set up operations overseas or move operations overseas. And I think they concluded that there were a variety of very legitimate business reasons for doing so. Japan recognizes that due to population growth, or relative lack of population growth in Japan, frankly, there's going to be more economic growth outside Japan. And the principal objective in Japan, policy objective, is what they call a virtuous growth cycle. A virtuous growth cycle would involve assisting, encouraging Japanese companies to grow outside Japan bring the profits back in Japan for enhanced domestic investment. They view the situation as a win-win, not as a zero-sum game. And consequently, at the end of the day, they concluded that the risk of jobs being shifted overseas was far less than the benefit of encouraging Japanese companies to expand and bring the profits back in Japan to help the Japanese economy.
Thank you. Mr. Schoen?
In the Netherlands, it's the same. The experience over the 100 years, has, I think, strengthened the Dutch government in its position that this is, for the Netherlands, the appropriate system, and on a net basis does not lead to a shift in jobs overseas.
Mr. Edge?
The concern in the UK, I think, hasn't been, as I've seen it here, that this encourages people to create jobs overseas. To the extent we've had concern, it's actually been that UK companies coming under the control of foreign multinationals has led to losses of jobs in the UK, rather strangely, and that's been quite a controversial thing in a number of areas recently. And the philosophy, I think, in the UK, as I've said earlier, is that actually if you try to use the tax system to force people to invest at home and make it less attractive to invest overseas, rather than letting everything be treated on a level playing field as part of a total package, then you will eventually make your own multinationals uncompetitive. And if you do that, then you go back to the first position, which is your big companies come under the control of foreign companies, and then you no longer have the national sway that you thought you have. So it's a matter of maintaining the influence and trying to make sure that businesses don't find tax a driving factor in where they put investment and do jobs. But it is, as I say, part of a package.
Thank you. Mr. Menger?
Yeah, the legislative history in Germany shows that the policymakers believe that the capital import neutrality would generate jobs in Germany by making German companies competitive abroad under competitive tax rates, and that is generating jobs in Germany to manufacture and design all the products which are sold abroad.
Mr. Yona?
Well, I don't know of any evidence that indicates that this particular provision, that is whether you tax or do not tax dividends paid by CFCs to the parent companies, has any effect on jobs by itself. But I think the broader question of the tax rate, the effective tax rate on foreign source income, certainly can have an effect on both income shifting and potentially job creation outside the country where the parent is incorporated.
Thank you. I yield back, Mr. Chairman.
Thank you. Mr. Johnson.
Thank you, Mr. Chairman. You know, it sounds like to me you all agree, since the U.S. last reduced its tax rate, corporate rate, through the '86 tax reform, that our major trading partners have moved past the U.S. in terms of reducing the corporate tax burden by lowering rates and going to a territorial system. Is that what you all are saying? Am I reading you right? It also eliminates our need for an IRS army to go out and try to persecute these companies, I think. Would you all agree that our current corporate tax system hurts the U.S. economy, the competitiveness, and jobs worldwide? Go ahead, Mr. Thomas.
I believe that it does. I mean, I work for U.S. companies and French companies and German companies in Japan, and many times when we try to set up transactions or we try to reorganize operations, the French and German companies really don't have a problem under their territorial system. The U.S. companies look at the particular proposal, and there's always seems to be a foreign tax credit problem or a CFC problem or some other problem that prevents them from doing what would be best for their business in Japan. And again, it's not an issue that the French and German companies seem to face.
Go ahead. You got a comment?
It's hard for me to judge what the impact would be from the U.S. system for the U.S. multinationals, but I would believe that if the Netherlands would abandon the territorial system, they would put their companies on a competitive disadvantage.
Competitive worldwide, you mean? Yes.
Not for me either, I don't think, to comment on the US system, except that I do remember during the 80s when we were looking at US-UK mergers, the US and advisors and us used to compete for which had the most horrible system. And both used to wonder as to whether we could really find somewhere else that was more friendly, and we looked at our friends in the Netherlands. Of course, at the end of the day, you came back to all the other parts of the package, so you ended up being in the US or in the UK because of all the other bits and pieces there. But from my perception, I would say that the UK has gone in the right direction of lower tax rates in a territorial system, and it seems to me that the US would benefit from that. It would be interesting to see what the position would be here if actually your capital markets weren't so strong and if you didn't have anti-inversion rules. That's certainly influenced UK government's thinking a lot.
Thank you. Mr. Menger?
Yeah, there are a lot of factors influencing US system, and it's very difficult for me to judge what is best for the United States. But I can mention that in Germany there were discussions, German legislators were looking at the US system once or twice and then decided it's too complicated for Germany and it would Germany put in a competitive
How about it's too
disadvantage.
complicated for us, too? That's a good statement. Mr. Yona, do you have any comment?
Well, I have to say I don't see our companies suffering so much. American companies recently have been doing extremely well worldwide, and the basic reason as far as tax is concerned, I think it's mostly for other reasons, but the basic reason for as far as tax is concerned is that we don't tax our overseas profits more than any other of the countries that are represented at the
Oh, yeah, but we're leaving money overseas because they're afraid to bring it back and get it taxed at a high rate. Under our current deferral system, but not under a territorial system, foreign earnings are subject to U.S. tax when they're repatriated to the United States. You know that. What I'd like to know from y'all is what did the UK and Japan do about cumulated foreign earnings when they transitioned to a territorial system? And I'm about to run out of time, so be quick, please.
Japan placed no restriction. Basically, any dividends that were paid from foreign subsidiaries during a taxable year beginning on or after April 1, 2009 were subject to the exemption.
You all agree with that? Mr. Edge?
In the UK, we didn't distinguish, and that would have been seen to have been an unfair distortion, as it were. But most importantly, the point was made quite forcibly to the government that if they did try to distinguish, the profits would end up in Ireland, not in the UK, because companies would leave.
Thank you very much. I appreciate your testimony.
Mr. McDermott is recognized.
Thank you, Mr. Chairman. I want to thank you all for coming here. I have a feeling as though I've seen this movie before because the Japanese have a healthcare system, and the Dutch have a healthcare system, and the English have a healthcare system, and the Germans have a healthcare system, and they're all different. And never have we had a hearing in the Congress where we asked them to come in and talk about how they run a healthcare system that's half as expensive as our own. So it seems strange that we're asking you to come in here and talk about systems developed in your own countries. And Dr. Abegonya, I would like to ask, you nailed it down to one issue as to why we're here. We're not going to do what the Germans do. We're not going to do what the English do. We will not do what the Dutch do. We will not do what the Japanese do because we're Americans. And we've developed this system, complicated, yes. Why are we having this hearing? It sounded to me like you were saying it's money left overseas, and we have two ways to get rid of the problem. One is to tax it while it's over there, just get rid of deferral. And then whatever, explain to me, why are we talking about competitiveness? Because in healthcare, we never look at the Europeans to see what's the best way to do it. They don't know anything. We only know. That's how our healthcare system was developed. The same as with our tax structure. So tell me what it is that we're really here discussing today.
What we're discussing is this very narrow question, it seems to me, which is what to do about dividends that are distributed upstream by CFCs out of non-separate F income. That's the issue on the table. And the other countries, some recently, some before that, have decided not to tax them. That has nothing to do with competitiveness. American multinationals are not, don't have any problem shifting profits around either from their overseas operations one to another, or raising money at home, or borrowing at very low rates, or even, I mean, their stock price reflects their overseas income. There's nothing in any of this issue of trapped earnings overseas that affects their competitiveness. They're perfectly finely competitive with the current system. The issue is that some people argue that leaving the money overseas means that they don't invest it at home. And, you know, you can argue about what the economic effects of that would or would not be. I mean, we had this one-year experiment in 2004-05, and the economic effects were not so stellar. But they did bring a lot of money home.
You mean the one where we
when we allowed
money
repatriations with a low
and they handed out in dividends
That's
rather than investing it in any kind of...
Right. But I mean, I think that you can argue that there is an impediment there. There's no question that they usually don't repatriate if they have to pay an extra tax, and they also engage in all kinds of complicated transactions to try to repatriate without paying the tax. So that puts a burden on the IRS to try to fight these transactions. And so I would say that there should be, something should be done about that. But in my opinion, if we were to reduce the rate to something more like the OECD average, we could abolish deferral, and then we could get rid of a lot of this complexity that's currently in the code, and we will not have a competitive disadvantage because of that either. And then the money can simply flow freely within the multinationals without having any tax effects.
Which way would you go? You have these two ways to go. Which way would you recommend to us to go?
So I would not recommend going territorial, because I think that this strongly increases the incentive to shift profits overseas. We know that American multinationals already use a lot of transfer pricing and other transactions in order to increase their overseas profits. And we have recently heard about large American multinationals putting their money overseas and paying very, very low effective tax rate on that money. And we have also had a hearing just last summer in this committee discussing about all the ways in which they use transfer pricing to shift profits. But I think the one disincentive currently that exists is this problem that if they put more money overseas, they will not be able to bring it back without paying taxes. And I think that if we eliminate that, this
It's to
incentive,
tax
then,
it as it's made.
right. But if
Then
we,
they can move it any place they want.
yes, if we abolish deferral, then there's no problem with transfer pricing, and they can move it any place that they want. They can bring it back here. There will not be a tax disincentive to do that.
Why do you think they don't want that? Well, I mean, we could pass a bill here in 15 minutes to get rid of the deferral, the ability to defer taxes and keep it outside the country.
I don't think that all of them don't want it. What I've read recently is that some of them have actually said that if the corporate tax rate is reduced sufficiently, they would be willing to live with such a system. That came from GE, which was one of the companies that was highlighted recently in terms of how good their overseas tax planning is.
Thank you. Thank you, Mr. Chairman.
Thank you. Mr. Brady's recognized.
Mr. Chairman, thank you for holding this important hearing. As opposed to healthcare, where our local doctors, for example, don't compete globally to provide services to us, our businesses, many of our businesses do compete globally for customers. And what we've learned through this hearing and others is that America has fallen behind, where we used to hold a distinct advantage in competitive tax rates. In fact, our global competitors have taken a page from our playbook and are beating us at it. It's costing us jobs. The goal today is to find out how we become competitive, to make sure that we have the strongest economy of the 21st century, not the strongest economy till China catches us or the European Union becomes more competitive, but how do we create the strongest economy for the next 100 years? So this hearing, I think, is very important exploring that. I want to follow up with Mr. Johnson's conversation and direct a question to Mr. Thomas and Mr. Edge, if I may. And by the way, all the panel has been excellent today. You know, as Mr. Johnson said, many critics of the current U.S. worldwide tax system argue the current system has a lockout effect, which forces U.S. companies to hoard cash overseas and not distribute those earnings back to the U.S., where those earnings could be deployed for domestic investments. There are, by some estimate, $1 trillion of stranded U.S. profits overseas eager to be brought back here. In fact, Mr. Thomas's testimony stated the lockout effect was one of the primary reasons why Japan adopted a territorial tax system. So to Mr. Thomas and Mr. Edge, based on your experiences, do you believe the lockout effect is an impediment to domestic investment?
Yes, I believe it is an impediment. Japan's rules have been in effect only now for a short period of time, but initial indications are that repatriation of profits is increasing. And frankly, given the recent disaster in Japan, more and more Japanese companies will probably need to bring profits back into Japan to help with their rebuilding. So I definitely believe that the lockout effect is a problem, and the Japanese government recognized that, and that's why they changed their system.
Thank you. Mr. Edge?
The UK hasn't had as much trouble with where overseas cash gets used because, as I explained in my testimony, we didn't have rules dealing with upstream loans. And that meant the money could be brought back to the UK with a further detriment to the UK because of the additional interest deduction that created. But it did nevertheless create a distortion because you then had money being lent back to the UK rather than being paid back to the UK by way of dividend and investing. And I think that once you've reached the conclusion that you deal with abuse through CFC rules, through interest allocation, through transfer pricing, then the essence of the territorial system as we've adopted is that you should take tax off the table in terms of deciding where corporations should invest their money. Yep. And therefore, I think that leaving cash offshore because there's a tax reason is an artificiality that it's very good to get rid of.
The comment has been made that the way you address and solve the lockout problem is that you either move to a territorial system or you end deferral. You know, most of the countries that have faced that decision have chosen to move to a territorial system. In your view, given a choice between ending deferral, moving to a territorial system, your recommendation to the panel?
Well, I would definitely recommend moving to a territorial system. Moving to ending deferral would be a step backwards. Again, the rest of the world is playing soccer, and I think for U.S. companies to be competitive, we need to move to a territorial system.
Right. Mr. Edge?
Me too. I think you get much greater complexity if you get rid of deferral, and then you have different ways in which income is calculated in different jurisdictions. If you go for a territorial system, it is much simpler. You let the total package that each country has to offer stand on its own.
Great, thank you. And again, appreciate the panel. Everyone's been very insightful today. Chairman, thank you.
Thank you. Mr. Nunez.
Thank you, Mr. Chairman. At this time, I'd like to yield my 5 minutes to the chairman of the Select Revenue Committee.
All right. Thank you, Mr. Nunez. Thank you, Mr. Chairman, for holding this hearing today. Kind of following up on what Mr. Brady talked about, Mr. Thomas, with respect to the lookout effect that he talked about. We had a week and a half ago hearing from 4 CFOs, and in response to a question from me, one of the CFOs with respect to lookout effect said that, this is a quote, "The tax code certainly is structured in a way where there are significant disincentives to bringing those earnings and profits back here to the U.S. So if we are looking to invest in the U.S., we have to find alternative sources of capital to make those investments." From to piggyback on Mr. Brady's question, from your experience in Japan, the Japanese experience, for what you just went through in Japan, what the Japanese just went through in Japan, can you give us some further insight as to the debate with respect to the territorial system and the lookout effect, and how that debate centered around creating more capital for Japanese in Japan?
Absolutely. And I think it's well known that the Japanese financial institutions are still in the process of recovering from the recent global financial crisis. And consequently, their ability to lend to Japanese companies is far more restricted than it used to be. That was one of the issues the Japanese government took into account. They wanted to encourage and enable Japanese companies and enable them to bring their profits back into Japan to avoid the lockout effect in order to help them continue to fund their operations and to do so in the most cost-effective manner. And the Japanese company, the business response, likewise, they felt it was much better for them to bring the profits back as opposed to trying to borrow within Japan under these circumstances.
Thank you. To the four of you, in the countries that you do tax work in, if you could just comment on this question that I have. Some of my colleagues on the other side of the aisle seem to link going to a territorial system and adding a value-added tax. We've heard that not only today, but in other hearings. Now, I have family in Italy, and from what I hear from them, and they're not tax experts, the value-added tax is to provide really for a social safety network or more of a welfare state. I certainly don't know what it is like in the four countries that you do work in. But starting with you, Mr. Menger, in Germany, was there a link between going to a territorial system and adding a value-added tax? Can you give us some context to that?
Yes, there was no link. There was no link. Germany, after World War II, had the participation exemption, the territorial system for corporate, and at the same time had a kind of VAT, was slightly different. Later it was governed by the European Union, but there is no link between the two. And also from a policy perspective, there's legislative history that you wouldn't be able, the policymaker wouldn't be able to change or raise the VAT rate in order to pay for changes in the corporate tax rate. Politically, there are clearly disconnected and separate issues for financing different needs of the government.
Mr. Edge?
That's true in the UK as well. I don't think there was any link between the VAT increases that we've had over the years, particularly one in the last budget, which was expressed to be to help deal with the deficit problem. The last government that I can remember in the UK making a major switch from taxes on income to taxes on spending was the Thatcher government coming in '79, when that was very definitely the trend at that point, and that was when UK corporate tax rates started going down. It's interesting, in one of the documents I put in there, the 2007 consultative document, the revenue themselves admit that the yield from foreign dividends is very low. Yes, there was a lot of cash offshore, but there was no basis under the tax system short of just grabbing it, which would have resulted in lots of people leaving, under which you could have got it. So I don't personally think, although you can't know what's in tax legislators' minds, that there was any link between the increase in the recent budget and exemption.
Mr. Shin?
I'm not aware of any such link in the Netherlands. As I mentioned, the territorial system was developed over a very long time, and the individual components of the Dutch tax system in general.
Mr. Thomas?
No, there was no link in Japan between the adoption of the territorial system and Japan's consumption tax.
Thank you. Yield back.
Thank you. Mr. Neal's recognized.
Thank you, Mr. Chairman. I can understand the conversation as it relates to businesses that take advantage of preferences that are built into the code and those who use legal mechanisms to seek low-tax jurisdictions. I think that part of the conversation as we discuss the territorial system versus the worldwide system, though, needs to focus perhaps on what our European friends have done to combat avoidance. And you've heard me say on the panel here many times, I believe there's a difference between avoidance and deferral. But tax evasion in no-tax jurisdictions seems to me to be an opportunity to promote some credibility as we pursue tax reform. And, Mr. Edge, how does the United Kingdom pursue tax evasion? And the difference would be, in this instance, the Cayman Islands, perhaps, or Bermuda, or Liechtenstein, or some of those no-tax jurisdictions.
The answer to that question is with handcuffs. Tax evasion is criminal. If it incurs, then the tax authorities will do everything they can to catch it. And there's been increasing cooperation between tax authorities, the agreement signed, which personally I welcome. I think that's a good thing. I think there's also somewhere between aggressive tax avoidance and what you might call routine tax planning. And certainly, as I say in my testimony, in the CFC area, there was aggressive tax avoidance in the past because the rules were perceived to be too harsh. I would personally be surprised if that happened in the future, because there's now a much better relationship between government and the revenue and industry, and that much more open relationship, plus the territorial system and what people perceive to be a tax system that's respected. You can't rule out human greed, but I hope that we will get to a situation where actually business will be able to carry on with business and not worry so much about, as I said earlier on, having to run very hard to get the effective tax rate down.
Thank you. Mr. Wenger?
With regard to Germany, Germany looked at your US Subpart F rules, PFIC rules, and Germany has a CFC legislation which applies if it's passive income and low tax. And in these cases, there's a full taxation in Germany. So it's a system which overlays and takes care of passive income with low taxation.
Now, Mr. Chairman, I would hope that we'd have an opportunity here in the committee to have a hearing on no-tax jurisdictions. I think that, again, lends some credibility to the task at hand, and that's how to make American corporations more competitive. And again, distinguishing between no-tax jurisdictions and low-tax jurisdictions, at least those who have low-tax jurisdictions have a corporate tax rate. So that's a separate argument. And Mr. Avioni, Mr. Edge stated that getting rid of deferral would increase complexity, but you're saying the opposite. Moving to a territorial system would put pressure on our transfer pricing rules and Subpart F rules, possibly leading to greater complexity in the tax system. Would the two of you care to elaborate?
Well, I think those two areas are pretty clearly areas in which abolishing deferral would greatly simplify our tax system. Subpart F, as you know, is entirely devoted over hundreds and hundreds of pages of regulations to drawing very fine distinctions between the income that is currently taxed and the income that is not currently taxed. All of that can disappear if we did not have deferral. Most of our transfer pricing enforcement and almost all the big transfer pricing litigation that we've had in this country are outbound cases, that is, cases about American corporations shifting income overseas. There were very few inbound cases, so all of that likewise disappears if you don't have deferral. In fact, Subpart F was enacted in part in order to bolster transfer pricing enforcements back in the 1960s. So other than the fact that we have a foreign tax credit, but even that is a complicated measure that we will have to retain if we abolish deferral. But I think even with territoriality, we're going to keep the foreign tax credit. Nobody suggests that we're going to abolish the foreign tax credit altogether, because we still are going to tax some forms of foreign, I mean, nobody is suggesting abolishing Subpart F either. So I think that territoriality keeps all the most complicated elements of our tax code and greatly enhances the enforcement problems that we face.
Mr. Edge, do you want to quickly respond to that?
Sure. I don't see the anti-avoidance aspects on a territorial system as increasing greatly the burden of the tax authorities. If you're trying to create jobs, I think a good way of creating jobs is to have armies of people working out what creditable taxes are.
Thank you, Mr. Chairman.
Thank you. Mr. Teaberry is recognized.
Thank you, Mr. Chairman. Mr. Avi Yona. Okay, I get my name mispronounced every day. I didn't want to mispronounce yours. You made a statement, now I'm going to paraphrase the statement, that the current, and correct me if I'm wrong, the current tax structure for the United States, you don't believe leads to American companies making a choice of moving jobs overseas, moving corporate headquarters overseas. I don't think you said it that way, but can you repeat that again with respect to our current tax structure?
I usually try not to talk about jobs specifically because, first of all, I'm not an economist, and second of all, I think the economics literature that I'm familiar with is ambivalent about what precisely the effect of U.S. multinationals expanding overseas on jobs here in the United States. There are studies, as you may be familiar, and there's been testimony before this committee before, that increasing U.S. multinationals operations is a complement to U.S. job creations, and there are other studies that suggest that it's a substitute, namely that you close factories here and move them overseas. I think it probably differs from multinational to multinational and depends on the situation. What I can say, however, is that clearly our current system creates an incentive to shift income overseas and profits overseas in an artificial manner. And that, I think, there is plenty of evidence for, and there have been a lot of reports both in the media and in academic literature recently about that.
Well, I guess trying to engage you here in your thought process, and maybe I can't convince you of this, do you not buy the concept, and I've talked to CFOs far and wide of American multinational companies, and we had a hearing a couple weeks ago, as I said earlier, who are growing their American businesses overseas with emerging markets overseas in Asia, in Europe, for instance, selling diapers. And when they sell diapers abroad, as an example, they are going to compete with somebody else who's selling diapers. If they don't sell diapers overseas, somebody else is going to sell those diapers overseas. When they sell those diapers overseas, they're not going to make those diapers in Ohio. They're going to make those diapers close to where they're being sold overseas. Now, some would say that's shipping jobs overseas, but if they're not going to sell diapers overseas, they're not going to make diapers overseas. And then you have this issue of returning the profits. And as they continue to compete in a world marketplace where they are being taxed differently than their competitors who are headquartered in Germany, in UK, in the Netherlands, or in Japan, they are at a competitive disadvantage. And we had 4 CEOs last week, one of which said, my biggest concern is that we are going to be taken over by a foreign competitor. I used to walk to school, grade school in Columbus, Ohio, and I could smell the hops of the brewery down the street that I thought would be an American brewery forever, Anheuser-Busch. It's no longer an American brewery, in part because of the international business that they do and the tax code, the American tax code. Do you just not recognize that reality in the world?
Seems to me that American multinationals, including, let's say, P&G, is competing very nicely overseas. I mean, one reason that they're doing that, of course, is that they don't pay too much tax on their overseas profits. And I don't think that there is any evidence that the effective tax rate that American multinationals pay on their overseas profits is higher than that of companies headquartered in any of the
But the tax
other
code that we have today makes them make a financial decision that if they bring those profits back here, they're double taxed, rather than if they're competing against a UK company that doesn't have to have that double taxation. So it's a perverse incentive for them to keep their money overseas, unless there's a tax holiday, keep that money overseas and invest it overseas. Does that not occur to you at all?
No. Well, first of all, they're not double taxed. There's no double taxation because we do have a foreign tax credit. When a dividend comes back, we only tax it if it hasn't been taxed overseas. We give a foreign tax credit if it has been taxed. And I don't think that this particular distinction has any impact on competitiveness of American businesses because they don't bring the money back if they're going to be taxed. The money is overseas, and they have plenty of money here in the United States.
My wife says men are from Mars and women are from Venus. I'm starting to think differently here. Mr. Edge, if you have a diaper company in the UK that is competing with an American company, did my analogy example make sense to you? And can you further?
Yeah, I empathize with it considerably. I've seen me nodding my head as you were speaking. And I think the correct answer...
Time has expired, so if you could just answer very quickly.
The correct answer is there is double tax because 2 jurisdictions are having a bite at the cherry. So don't level down, allow each jurisdiction to stand on its own.
Thank you. I yield back.
Mr. Davis is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to follow a little bit on this line of discussion, maybe in a wider area. I'm a little surprised about the commentary that American companies are doing just fine overseas. I have a question related to this competition between tax systems, and I'm intrigued that as Britain and Japan have moved into this area. The first area that I'd like to touch on is the area of merger and acquisition. My colleague just mentioned the American brewing industry, where it used to be American at one time. But as I've looked particularly in the spirits industry that's prominent in Kentucky, companies like Brown-Forman, among others, that are major players in the industry here in the United States, I get the sense, looking at comparative tax structures between the Europeans, where the English and the French are dominating acquisitions right now, that you can have 2 companies that have essentially the same level of competitive edge of the ability to create margin, if you will. And I'm saying that outside the sense of a tax construct for a moment. But as I began to look at the advantage that a European company could bring to the table, specifically a British company in an acquisition, versus an American company with the same revenues, the same general gross margins. It appeared to me in acquisition after acquisition that I looked at over the last several weeks that the American company was often at a 10 to 15 or more % disadvantage in the offer that could be laid on the table for an acquisition that has somewhat turned the tables, where we're seeing American industries, let's say, being gobbled up in many aspects. Would you all like to comment on that?
From a strictly British point of view, I hope, though it's rather disloyal of me to say that your fear is right, but I think it does go back to the same theme. I think we've moved from a situation where the British competitors you're no doubt thinking of have had to run very, very hard with our CFC rules, the equivalent of your deferral problem. First, try and make sure the income isn't currently taxable, and then find ways in which you can move it around to keep a low effective tax rate. What I rejoice about now is, with the work that was done by the last Labour government and the current coalition, I think we've moved to a very sensible system. Now, life will tell us whether or not it's a good system for the UK, but to me at present it feels like a good system and should make our multinational champions more competitive, I think, because deferral isn't a feature and people can plan with much more certainty.
So you would go on, you would say then that your tax system gives you a competitive advantage over us on the same playing field?
Yes, it would. As I say, it's all part of the package, and America has got huge other strengths. But purely looking at it from a tax point of view and knowing the little I know about the US system, I would say where we've got to now is a very good place.
We don't like being in that place at the moment, but I guess the question, though, and it's important in terms of international commerce, would it level the playing field in terms of the effectiveness of the global economy if we, too, had a territorial tax system here, particularly from a standpoint of doing merger and acquisition?
From my point of view, yes, it would. And of course, as I've said a few times, it is part of the package. I think you've got things in your package that are pretty impressive. So whether the playing field will be level or be tilted in your favour again, I'm not sure. But on the tax side, I think a level playing field, through my eyes, would be helpful.
We just like to keep our spirits industry owned by Kentucky companies right now, at least for a few specific brands. But Mr. Thomas, do you have a comment?
Yes, I would definitely agree with Mr. Edge's comments. Businesses make decisions, investment decisions, on the basis of return, after-tax return, and to the extent that American businesses are faced with a lower return as compared to foreign businesses, they put it at a disadvantage when they're trying to engage in these types of transactions. So I definitely agree.
I appreciate that perspective very much. Thank you, and Mr. Chairman, I yield back.
Thank you. Mr. Doggett is recognized.
Thank you, Mr. Chairman. Thank you, all of you, for your testimony. There are some here who believe that we ought to borrow from the Chinese and our other creditors or shift more of our tax burden onto small businesses and individuals so that a few large multinationals can pay even less than the relatively low effective rate that they pay today when they pay taxes. General Electric and a few others don't even bother to do all that much of that. In the cries for lower corporate tax rates, there is also the immediate demand for a rate of about 5% on previous earnings that have been accumulated abroad in what is called a repatriation tax holiday, but what is certainly not a holiday for most American taxpayers. At a cost of $80 billion, we cannot afford to lower the corporate tax rate to 5% on the cash that multinationals have stashed in foreign tax havens. At our last hearing, fortunately, all 4 corporate witnesses called by the Republicans agreed that such a standalone 5% repatriation tax break was a very bad idea, in the words of one of the witnesses, to which the other Republican witnesses agreed. Whether we're discussing this immediate or more permanent changes in our tax laws, I believe the focus has to be whether we are encouraging jobs and growth in America or we are incentivizing the export of jobs and capital. Mr. Abiona, you've testified earlier about jobs, but let me ask you a more narrow question. Is adopting a territorial system an efficient way to create jobs in the United States?
No.
will adopting a territorial system help us prevent multinationals from shifting billions of dollars out of the United States?
No.
And with reference to, you've referred to transfer pricing rules, we know that we already have a system in place in which multinationals stash billions of dollars overseas, and that not all of that money is on earnings overseas, but is in fact earnings from American consumers that have been categorized as foreign earnings and shifted to tax havens. Steve Shea, who was sitting in your chair not that long ago as the Deputy Assistant Secretary for International Tax Affairs, just recently again objected to the very territorial system being considered today and declared, quote, "No other country with an exemption system has successfully protected its domestic tax base from abuse. They all are struggling with transfer pricing." Let me ask you, if I understand the way this great territorial system is going to work, the idea is if you have any earnings overseas, you don't owe any taxes at home on those. And if you have earnings at home, you pay whatever the statutory rate is, 25, 28, 30%. Doesn't that create a slight incentive, a more than slight incentive, for a multinational to categorize earnings at home, particularly with intellectual property like a formula or trademark, as foreign earnings so that they won't have to pay any taxes on it?
Yes.
And so you've referred to the current rules and their inadequacies. The effect of that in incentivizing the export of what are truly American earnings to tax havens only increases, doesn't it?
Yes.
And let me ask you also, we've heard the cries today, right from this committee dais, about American corporations having to pay 35%. And I'm one who believes, as I think every witness testified today, that we should be looking at the level of that statutory rate, even though few multinationals actually pay the statutory rate. But I want to be sure that I understand how that interfaces generally with our foreign tax credit rules. If I understand, if a company packs up in Ohio or Michigan or Texas and moves those jobs to China and opens a factory over there, and they pay the Chinese 25%, 25 cents, say, on every dollar that they earn from their factory in China, the objection is that if they bring any of those profits back to the United States, they have to pay 10 cents on the dollar here. Is that the way that the system works? It's actually, I think that's a little too favorable to the corporations because there are all other kind of gimmicks under the foreign tax credit rules so that you sometimes can get it even higher than the statutory rate in the country where the manufacturing is located. But is that generally how it works?
Yes.
Thank you.
Gentleman's time has expired. I recognize Mr. Reichert for 5 minutes.
Thank you, Mr. Chairman. I want to thank the panel for being here today also. It's a great opportunity for all of us on the committee to hear from the different experiences that you've had representing the countries and the organizations that you represent from around the world. So I think it's a great opportunity for us to gain some wisdom from you, and I think that's always a good thing if we can have that sort of dialogue. We may not adopt everything that Japan does, or the Netherlands, or Germany, or the UK, but certainly we can adjust things to fit the United States as other countries look at us and use some of those ideas that we use here in the United States. So that leads me to a question that is on a topic that's very near and dear to the hearts of the people who live in the Northwest, and especially in Northwest Washington, where some of the most well-known tech companies are from, Microsoft and others. So Congress, as you know, is considering a wide range of ideas looking at patent reforms to protect intellectual properties from counterfeiting and from theft. We're also looking at ways as to way we might be able to encourage innovation in those areas. And of course, as you know, innovation in America is one of our calling cards. We're proud of that, and we want to encourage that. I do understand that the Netherlands and I think the UK has a special tax treatment that you've I think that was referred to in one of the statements, intellectual property patent box. Can Mr. Schoen and Mr. Edge, can you explain the concept of a patent box and the idea behind it to encourage and keeping IP within your country's borders, but also recognizing that it's a domestic tax proposal, but there are some international implications. Can you address those two issues, please, Mr. Schoen, Mr. Edge?
Okay, I'll start. Yes, I did refer to the patent box, and the patent box has been the result of quite a long and broad-spread inquiry in the UK into what we're doing about R&D. We've got some great companies there, particularly in the pharmaceutical area, where R&D is important. And Sir James Dyson of vacuum cleaner fame has set up a committee to look at it in the UK. One of the conclusions on this was that this should be an area where we went beyond a level playing field on tax and went a little bit further to say, having had research and development credits over the years, which have been enhanced deductions against tax, we should have a favourable tax regime for income from patents. It's quite limited. It's a 10% tax for income from patents that is received within the UK, and a little bit like I referred in my testimony to tonnage tax. We've had REIT rules, as you have in the US as well. It's a rule that's designed to encourage activity within a particular area, and we're taking a gentle step in that direction. It does also have some international implications as well, because in our CFC changes, we're saying that income from patent income is good income, or income from intellectual property is good income, unless that intellectual property started off in the UK and has been exported. So in those two ways, we're trying to encourage innovation, not stifle our multinationals, but actually just give a little fillip to R&D in the UK.
And you're looking at a law that may go into effect sometime in 2012, is that correct?
That's absolutely right.
And are you looking at the Netherlands laws? I see that the tax rate is still, it's 10%, I think, in the Netherlands also. And you're looking at a 10% tax, too.
In the Netherlands, it is currently 5%. It started out at 10% in 2007 and was reduced in 2010 to 5%.
Okay.
At the same time, the scope was broadened. It was limited to patents initially, self-developed patent, but it's broadened to certain specified R&D activities, development activities, but it does not include trademarks, etc. So it's focuses on technology, including software.
Thank you, Mr. Chairman.
Dr. Bustani is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for your testimony. Critics of territorial systems argue that the systems oftentimes put excessive pressure on transfer pricing. Mr. Thomas, do you agree with that?
I think that it's fair to say that it puts some additional pressure because there is potentially a greater incentive. However, the question is how much and how you take that pressure into account. There's been tremendous developments in the transfer pricing field in the past 10 years. Countries outside the U.S., countries all over the world now are becoming very sophisticated, and companies have to deal with transfer pricing not only in one country but in another country. And the tax authorities are becoming more adept at evaluating transactions that may be abusive. Yes, I think there's greater pressure, but my own view is that pressure is not a sufficient justification to not change to a territorial system.
Well, and if we have a higher corporate tax rate, lowering the corporate tax rate would obviously reduce some of that pressure on transfer pricing. Is that
That's correct. And even though it wasn't directly related to the adoption of a territorial system, Japan has proposed a reduction in its corporate tax rates. It may be delayed now because of the disaster, but I believe that they will ultimately move ahead with that.
Mr. Edge, do you agree with those comments?
Yes, I certainly agree on the comment about how tax authorities around the world have become much more sophisticated in dealing with transfer pricing, and with your comment that certainly from my experience in the UK, if you have a lower tax rate, there are still going to be some people who will engage in tax avoidance because that's human nature, but the incentive to do so will be less. The In the UK, with the CFC system we've had, which has generally been kind to active income, of course, transfer pricing has been very much part of the UK's protection. So I don't see that changing. And the other thing that's been a big change in the UK in the last 4 or 5 years is much more real-time working between the revenue and industry, which has really helped. There's a much more open, trustful relationship, no surprises culture, and that helps enormously.
I've heard mixed reviews about advanced pricing agreements, and I'd like to hear each of your comments with regard to your experience. Mr. Thomas, why don't you start?
Well, Japan actually invented the advanced pricing arrangement back in 1986 when they adopted their transfer pricing rules. They called it the pre-confirmation system. After a few years of perhaps mixed results, from about the mid-90s, it has become a very successful program. Indeed, in Tokyo right now, there are more examiners who are involved in the APA review process than there are in transfer pricing examinations. We're finding that renewals are becoming more easy to do and quite efficient. So that's, and we're finding that other governments increasingly are adopting procedures for advanced pricing arrangements so that these can be done on a bilateral basis more effectively and more efficiently. So I think that there's tremendous promise in that program, and that can also go a long way to help with the whole transfer pricing issue issues that may arise in connection with the adoption of a territorial system.
Mr. Schoen, what's your experience?
Well, in the Netherlands, it's very common to conclude advanced pricing agreements on transfer pricing matters, and that settles a lot of disputes in advance.
Thank you. Mr. Edge?
APA's transfer pricing agreements invaluable in the financial services area. It's enabled banks to have a great deal of flexibility in running their operations. Very useful on inbound investments. A lot of US companies coming to the UK have found the ability to clear their charging arrangements useful for headquarters and cost-plus operations. More suspiciously treated in other areas, perhaps 5 years ago, now becoming more common as the revenue have got better at transfer pricing investigations, and an investigation is usually followed by an agreement for the future.
Mr. Menger?
Yeah, in Germany it's becoming more and more popular. APAs were catching on slowly, but now it's very helpful for the taxpayer and the tax authorities because you have certainties about your international transactions.
Thank you. I yield back.
Thank you. Lewinauer is recognized for 5 minutes.
Thank you. I want to just see if I can understand the context. Mr. Avione mentioned the context of tax reform. Mr. Schoen, in total taxes in the Netherlands approaches 40% of GDP, is that correct?
I do not have those statistical data available at me at this
point.
Well,
I have here the OECD tax statistics database for 2008, before weird things happened, and it says in this that it was 39.1% total tax revenue as a percent of GDP. Is that reasonable? Is that in the ballpark?
As I said, I can't comment on that.
You don't know?
I can review that if you want.
Let me turn maybe Mr. Edge. If you have some sense of the total tax burden in the United Kingdom, the same chart suggests, doesn't suggest, it tells me that it's 35.7% total tax burden percentage of GDP. Is that reasonably accurate?
I don't have it at my fingertips, I'm afraid, but that sounds about right. And it's clearly a figure that government focuses on as you go by, along with the balance between the different forms of tax that we have.
Right. Mr. Menger, in Germany, it says 37%. Is that ballpark figure?
I'm not an economist and don't have the numbers at my hand, but I believe
you're a tax expert.
I believe it's an accurate number, yes.
Okay. Mr. Aviona, my chart here says that total tax percentage of GDP in the United States is 26.1% in 2008. Is that in the ballpark, in your judgment?
Yes.
You, in your final point, which you kind of rushed by in your testimony, you referenced the context of tax reform. Does the conversation that we're having this afternoon, does it make any difference that these other countries have much higher tax burdens on individuals and businesses, on managers and suppliers, when we're talking about both the impact of tax changes and the capacity to be able to make a tax change that, according to joint tax, would cost $80 billion a year to the Treasury? Could you talk a little bit about the context?
I think that makes a tremendous difference. I mean, the fact of the matter is when American companies migrated before we adopted the anti-inversion rules, they never inverted to Japan or to Germany or to the Netherlands or to the UK. They wouldn't dream of it because of these other taxes. I mean, the total tax burden on the headquarters of a multinational has to be measured to include the tax burden on the management and on the employees and the VAT that they all pay in all of these other countries. And you can't, in my judgment, talk about competitiveness in general in the abstract without taking all of these other taxes into account. The other point, of course, is despite, you know, the claim that the two things have nothing to do with each other, as a practical matter, if you're going to significantly reduce your revenues from the corporate tax to the tune of $80 billion or more, it's helpful to have another tax that can be raised relatively easily to compensate for that, and that's what every other country does, but we don't.
Thank you very much. I appreciate that, Mr. Chairman. I think my friend Mr. Doggett pointed out that this is would be the functional equivalent of a permanent repatriation, good, bad, and different. I mean, I just think our putting on the table what it means for the United States having a relatively lower tax burden than all these other countries. Japan are basically the same. It'll be interesting to see how that retains over time with exploding costs for an aging population in Japan. But the other three, it seems pretty clear, and it seems to me important for us to try and understand the total context about what we would be getting into and what the likely consequence may be. And I think it's worth our exploring further. Thank you, and I yield back.
Thank you. Mr. Buchanan is recognized.
Thank you, Mr. Chairman, for holding this important hearing today on taxes, and I want to thank each of our panelists for being here today also. I believe we need to reform our tax code to get our economy going and get people back to work. But Mr. Thomas, I noticed in your remarks you concluded, you stated that the United States, its corporations struggle to deal with a very complicated and burdensome U.S. worldwide tax regime. Would you all agree that our tax code is outdated and a barrier to economic growth or prosperity? That was kind of your conclusion. I just wanted to follow up on that point.
Yes, I would agree with that. I think that as we see what's happening around the world, all these countries that either have for years have had a territorial system, or UK and Japan most recently, having gone through the thought process, have reached a conclusion. And I think there's no reason why the United States shouldn't reach the same conclusion.
And along that line, what would be your couple of recommendations to us as a panel to supercharge or get our economy going or help our corporations worldwide?
Well, I think the adoption of the territorial system along the lines of what the UK or Japan has done, the dividend exemption, to encourage U.S. companies to bring their profits back into the United States and avoid the lockout effect.
And the other thing, I just wanted to touch base a little bit on Japan. I remember in the 80s, we had offices in California. It just seemed like Japan was going to own everything. How is their tax code there? Has that made a difference? Has that bogged them down? The reason I say that, because I remember in the late 70s, Hong Kong had a flat tax of 20%, and I was over there the other day, seeing they went to 16 or 16%. But with Japan keeping their rate, it seems a little bit higher. Has that made a negative impact? And then do you agree that's affected us as well, being competitive?
I think that it has had a negative impact, and that's why there were very strong calls in Japan a couple of years ago to reduce Japan's corporate tax rates. Many of us were calling for a reduction closer to 10% from their 40%. Ultimately, they decided to reduce the national corporate rate to 25%, so all in it's about 35%. but they did recognize that the current high rates were hurting them.
Mr. Chairman, I yield back.
Thank you. Ms. Jenkins is recognized.
Thank you, Mr. Chair, and thank you all for being here. In his prepared testimony, I believe it was Mr. Edge, you spelled out the real danger of having an uncompetitive tax system in an open economy like that of the United States and UK. The fear is that our international competitors with a lower tax rate can afford to pay a higher purchase price when making acquisitions. If U.S. companies become subsidiaries of foreign firms, their fair market value might rise because they escape worldwide taxation. Studies have shown that foreign-based companies take over U.S.-based companies 3/4 of the time when there is a cross-border merger. The alternative to tax reform could be continually making our companies takeover targets. Could you all elaborate on the role that tax reform could play in our increasingly competitive and global marketplace to put U.S. multinationals or future U.S. multinationals in a position where they are the acquirers and not the targets, but serves to protect our domestic tax base?
Yeah, certainly lower tax rates would increase after-tax returns for any particular investment, and consequently, in order to be competitive, the U.S. companies should be placed on the same level playing field as other countries around the world now, and the adoption of a territorial system would in effect result in the foreign taxes being essentially the only taxes that would be paid in connection with those transactions, and put the U.S. companies on the same position as their competitors.
It's again speculation on what the U.S. should or should not do is not for me to do. But as a general statement, a lower effective rate obviously increases your payback period or your rate of return, as was earlier addressed.
I think this is an all other things being equal question, but you're right. The drift of my testimony is exactly in that direction, because I have seen UK companies not able to make acquisition and see that other companies, rival bidders, have had better tax attributes. And I've also seen UK companies fall under foreign ownership, and then gradually you see businesses move out of the UK. So I think those fears are very real. But as I say, it is all other things being equal, because if you're bringing other things to the table in innovation, capital market strength, then it may well be that you can outbid the tax system. But all other things being equal, I think it must be a positive move to lower the effective tax rate and make yourself more competitive so you become the acquirer and not the target.
To acquire companies, you have to look at the return of investment, and you have to look at the deductibility of interest, and both, of course, are affected significantly depending on what kind of tax system you have. And the better the return is, the easier it is to take over your competitors.
I don't know of any evidence that cross-border M&A is driven primarily by tax considerations. It's driven primarily by business considerations. This is not the inversion saga where this was purely tax-motivated transaction. Large cross-border M&A is driven by the ultimate needs of business to expand, and the United States is a very, very important market. It's the richest and biggest market in the world, so it's not surprising that foreign companies are interested in making acquisitions here in order to access your markets. I think that's a positive thing for the United States.
Okay, well, it would seem that the tax bills of these major corporations would be a business decision as well. So I think it would factor in when you call it a business decision, would it not?
I don't think that the tax bill that American multinationals pay is significantly higher than the tax bill that foreign multinationals pay. So I think that all these tax considerations are not particularly relevant, because there's no evidence that I know of that shows that American multinationals are taxed more heavily than multinationals from other countries.
Okay. One final question. It looks like we're running out of time. I'm just wondering about exports. The president has stated that a goal is to double exports, and many of the companies that we've talked about, we've heard about from your testimony today, indicate that they have more exports than the United States, and maybe I will follow up in writing with you because I hear the gavel. Thank you. I yield.
Thank you. Mr. Kind is recognized.
Thank you, Mr. Chairman. I want to thank the witnesses for your testimony and feedback here today. Professor Aviona, let me start with you. Here's one of the concerns, and I know it's a little bit off topic here today, and we're talking about corporate tax reform here, but the majority of businesses in America are pass-through entities, so the individual rate's terribly important. And yet, if you take a look at the overall corporate tax rate, the goal trying to reduce it to the mid to upper 20s, you know, if we got rid of all the tax expenditures on the corporate side, except for accelerated depreciation, the best we can do is 31% rate. Getting rid of accelerated depreciation, we can get down to 28%. Assuming we hit that mark, what would be the response with these pass-through entities, the majority of businesses in America, if we had a corporate rate at 28% with no expenditures at all on the corporate side?
Well, I mean, I think the concern would be that the bigger the disparity between the rate that you impose on pass-throughs and the rate that you impose on corporations, the more shifting there would be from one form to the other, based primarily on tax consideration, that it will go back. I mean, we used to have the system for many years where there was a huge, I mean, traditionally the individual rate was much higher than the corporate rate, and the result was that a lot of earnings, even more than now, are parked maybe unnecessarily inside corporations and are not used in the best way that works for the economy.
Yeah, well, let me ask you as well, because you know, one of the difficulties that we have in dealing with this, if there's agreement that we should do it in a deficit-neutral fashion, is finding a way to pay for it. And there's obviously the corporate tax expenditures in one area, but that's only 8% of the entire expenditures in the U.S. tax code. 92% is on the individual side. Should we be approaching this comprehensively, not just on the corporate, but also on the individual side, given that, again, the majority of businesses are pass-through entities?
I think it makes sense to address tax reform comprehensively and to address tax expenditures, not just on the corporate side, but other tax expenditures as well, as the various deficit reduction commissions have proposed.
Well, I don't think it would go over very well as far as the pass-through entities if we start going to their side of the ledger in order to help pay for a lowering of rates in the mid-20 range or something, which seems to be a goal that many of my colleagues are striving for. So if we don't go to the individual side, we eliminate all of the corporate expenditures. Again, that gets us at best to 28%. If you want to go lower than that, are there any other acceptable offsets to help pay for a lower rate? Such, should we be looking at cap gains, dividend, or both? Dialing that in order to pay for a lowering of corporate tax rates?
In my opinion, yes. I mean, I would increase the cap gain and the dividend rate in order to pay for corporate tax rate reduction.
Yeah, do our other witnesses have an opinion on that as far as the dividend rate right now as it currently exists, so the cap gain rate, as far as looking at that with the goal in mind of trying to simplify and lower overall corporate tax rates? Sure, go ahead.
I'd be happy to make a comment based on the UK experience. I referred to Northern Ireland earlier on, and I did quite a lot of work there in the 1970s, before the 1979 Conservative government came in with the objective of broadening the base and lowering the rates. And I found that Northern Ireland politicians were very much saying that if they had a high rate but heavy deductions for capital incentives, they ended up with investment coming in the form of, if you remember Mr. DeLorean, whose business wasn't terribly successful, where the Southern Ireland, with a lower tax rate for profitable companies, got people who didn't want somebody to risk share on capital with them, but were very happy to know that they would make profits later and pay a lower rate. So, as you probably gathered, I'm afraid I'm a completely unreformed lower tax rate person. If that means broadening the base by getting rid of deductions, I think that removes the distortion as well.
Well, Mr. Edge, let me just stay with you for a second. One of the goals that we have with this, again, is overall tax simplification to make our companies more competitive and the ability for that capital sitting offshore coming into the United States. Do you think just by going to a territorial system without recognizing the additional revenue forms that the developed nations have right now, the VAT being one of the primary ones, is a realistic approach for us to take here in the United States? I mean, with the budget deficits in mind that we're facing?
I don't know, because I don't know actually what your fiscal constraints are. As I said, in the UK, I think we've been able to bring it in without a big immediate fiscal cost, and the decision has very much been based on the fact that if you tried to raise more revenue from our big multinational corporates, you would be going in completely the wrong direction.
I just hope we're not operating in a vacuum without recognizing the VAT and other forms of revenue that other nations are dependent on as well. But thank you, Mr. Chairman. Appreciate it.
Thank you. Mr. Paulson is recognized.
Thank you, Mr. Chairman. Also, thank you for all being a part of this hearing and taking the time to testify. It's gone on for a while. And I was just curious because we've heard the perspective from Japan, Netherlands, England, Germany, et cetera. And is any country that you're familiar with, whether it's those individual countries itself, or are there other countries that you're familiar with that are talking about going back from a territorial system to a worldwide system like the United States has?
I haven't heard of any countries thinking along those lines.
Shun?
I'm not aware of any.
Mr. Edge?
No, me neither. And the French, as you probably know, have a mondial system under which they treat everybody as being in France, the best place to be. As I understand it, they're not expanding that either.
I'm not aware of anybody.
And thank you for that. It kind of underscores the point. The reason we're having this discussion is about competitiveness and what we can do to actually create jobs. I know Mr. Aviona had a chance to answer the question earlier, but when one of my colleagues asked it, but is the country that you're familiar with, whether, again, Germany, Japan, Netherlands, England, is the country you're familiar with in adopting a territorial system, is that, if we did that in the United States, is that an efficient way to help create jobs in the United States?
Well, I think if the United States takes into account the kind of considerations Japan took into account, that it would lead to creation of jobs.
Mr. Shun?
Yeah, that is, again, a matter of U.S. tax law, which is very complex, and there's a lot of factors. So I can refer to the Dutch experience, where we believe that is the case.
Mr. Edge?
By levelling the playing field for business investment and removing the threat on our multinationals, I think it has a good tendency in that direction.
Okay, Mr. Menger?
It's a very complex question and a lot of factors going in, and as a German tax expert, it's difficult to give you an answer to your U.S. question.
Yeah. Well, and there are a lot of complex factors as a part of the U.S. tax code, because it's a lot larger than the version you brought from Japan, certainly. Can you also answer the question, will it help protect, potentially help protect American jobs and American jobs from being shipped overseas if we looked at moving to a territorial system? Mr. Thomas?
Again, when Japan considered that question, they concluded that this is not a zero-sum game. They concluded that it's a win-win situation. It will take a lot of effort, but it is unavoidable that markets overseas are growing, and Japanese companies need to address that growth, and U.S. companies need to address that growth. And if they can take advantage of that growth effectively and then bring the profits back to the United States, that will serve to enhance the U.S. economy.
Mr. Shun?
Yeah, the Netherlands has had these same considerations, and as an open economy has concluded that that would be the way to go.
Mr. Edge?
The UK benefits enormously from inward investment, particularly from the US, and I think anything that will foster that is a good thing and should be good for jobs. There's some paranoia about foreign ownership, and anything that actually goes in that direction, some would say is a good thing too.
Mr. Menger, anything to add?
I think it's helpful to generate jobs.
Okay. And I know that that's a big conversation we're having, is how to increase economic growth. And I mean, I do agree with my colleague from Wisconsin's comments too about making sure that corporate tax reform is not the only provision that's on the table, because those small entities, partnerships, S corporations, et cetera, that pay under the individual rates, that has got to be a part of the conversation for the foundations of overall tax reform, which I know our chairman is a part of as well. So thank you for your feedback and for being here today. I appreciate it. Yield back, Mr. Chairman.
Thank you. Mr. Engel is recognized.
Thank you, Mr. Chairman. I know the hour is late, and I want to thank all of you for your patience with the committee. I find it difficult to just talk about corporate tax rates. In the United States, when we do tax reform, individual tax rates politically has to be addressed. But from what you're saying, it's like it's two separate issues, that you can just do the corporate rates and not the individual tax rate?
Well, Japan is undergoing a comprehensive review of its tax system. It's considered the corporate rates, it's considering individual rates, considering consumption tax.
Would anybody consider just the corporate rates and not figure what the individual tax rates would be? You would.
Yeah, I would. I think because obviously the government's got to balance the books, which is the most important thing, and create the right infrastructure. But I would personally say that the corporate rates have got to be set at a level that attracts investment and encourages global competition, and individual rates are affected by different things. They're part of the social responsibilities. So personally, I think different factors come into play on individual rates and corporate rates, and therefore the two don't go into tandem. But at the end of the day, the government's got to...
If you were considering a deficit like we were, and you wanted to see where the revenue would come from, would you not want to consider what percentage came from the individual tax rates and the corporate rates? And as some other members had indicated, where we have a payroll tax for health care and Social Security, many European countries do not tax that directly, and they just provide this service.
Sorry, that's me. I think, if I can say so, that that's a political question, and the answer to it will then have to be given having taken into account the economic consequences. But in answer to your first question, I think the corporate tax rate is something which you should look at economically first and then decide whether it is politically acceptable.
Well, since our economy is so much larger, I gather that you don't really think that the different sizes of our economy makes any difference as it relates to what the corporate structure looks like. But it would help me if, without going through it now and taking the committee's time, if you could tell me the percentage that your country receives from individual tax rates and the percentage it receives from corporate tax rates, and whether or not there's a VAT or some type of tax. I assume you have a very high individual tax and low corporate tax. Is that correct?
Yes, in Japan, the individual income tax yields about 13.5 trillion yen, the corporate tax about 7.8 trillion yen, and the consumption tax about 10 trillion yen in total.
Thank you. Mr. Berger is recognized.
Thank you, Mr. Chairman. Thank you for being here. You know, I'm interested in really the public perception and the dynamics that went into the tax reform change. And so really, what was the public perception of your tax system before you did the reform? Mr. Thomas?
The Japanese public perception of the tax system. I think that they feel that the income tax rates are high. I think it's fair to say the consumption tax is not the most popular tax, but they have become quite accustomed to it. And it is now in Japan required that the consumption tax be used to pay for national pension and health care for the elderly and senior care. The corporate tax, you know, it's hard to say what the Japanese public thinks about the corporate tax. But Japan has had a very international-minded business community, and I think the Japanese public supports. The Japanese companies need to be able to compete effectively globally. And so, you know, my sense is that they have a favorable view of the recent changes that have been made.
Thank you. Ms. Schoen?
Well, the Netherlands, you know, as indicated earlier, the Netherlands did not go through tax reform to get to a territorial system because we've had that for a very long time. So it's ingrained in the Dutch tax system, so that discussion did not take place in the last.
And maybe what I'm asking you, just the public perception now then of your tax system, you know, the average person, where are they at on?
I think that most times the most average persons would think his own tax burden too high.
Similar, yeah.
But overall, it is also a factor of the level of service that you get back for the taxes that you ultimately pay.
The financial press, of course, has been generally supportive, I think, of the direction of travel, but the sort of issues we've been talking about today don't really translate terribly well into the popular press. How much tax banks should pay and how much tax bankers should pay is very much in their thinking, and the answer is a great deal. At the individual level, I think if you're asking what the man in the street thinks about it, then I would say they react more to the notion of a well-known British name coming under foreign control and the implications that that then has on jobs than they do about what sort of corporate tax system we should have for multinationals. But there is nevertheless a movement within the UK Uncut system, which you've had, I think, some semblances of here, which looks at multinationals and assumes if multinationals paid more tax, there will be less government cuts. But I think that's the only manifestation we've seen of a debate about the issues we've been talking about here in the popular sector.
Thank you.
Yeah, the German corporate tax system changed in the early turn of the century. The average man on the street doesn't really look into what the corporate tax issues are. It's looking more at its own tax, and I'm referring to what Frank already said. The tax is too high and it's too complicated with regard to individual taxation.
Thank you. I'll yield back, Ms. Sharon.
Thank you. Mr. Pascrell is recognized.
Thank you, Mr. Chairman. I want to thank the panel. I believe we come out of this or at this from two different perspectives, and that's very unfortunate. One picture is, and I'll tell you that's the approach I take to everything, income inequality. And your approach seems to be corporate disincentives. While one is not correct and the other incorrect, that's the approach, you know, we approach this issue. I have to respond, Mr. Chairman, from my gentle lady friend from Tennessee who said, made some comments about corporate taxes, taxes on corporate income. Absolutely incorrect. Mr. Aviana, correct me if I'm wrong. It would seem, looking at the chart of all of the countries that we trade with, major companies, 25, 30 companies, that we have the lowest taxes on corporate income of any of those countries.
As a percentage of revenues, that's correct.
As a percentage of GDP.
Yes.
And that's because many of us are talking about not the marginal rate, which we like to refer to, but doesn't take into consideration the different deductions in each of the countries, which is the effective tax rate. So that is, I want to correct the record, Mr. Chairman, and I will stand corrected if I am wrong. I think that this is a very important point, and I bring this up for everyone's review. Looking at all of our trade partners, we do not do very well. Or rather, no, let's make a correction. We do very well when we talk about the effective rate. Now, I want to ask these questions. When we're shifting money, Mr. Aviana, when we're shifting money out of the United States of America, that means that the filers here in this country, those people who file income taxes, pay more money in their taxes, must pay more money in their taxes to make up for the loss of revenue. Is or is not that correct?
The government faces certain amount of revenue that it has to raise every year, and to the extent that it undercollects from a certain sector, then it has to compensate. So I think that's right.
Gentlemen, don't you blame me for being concerned or fault me for being concerned that in New Jersey, the state that I'm from, that state and the state of Delaware pay a lot more in taxes when individual filers because of this situation. In New Jersey, income tax filers pay $752 more in taxes because of a system which I don't know whether we're advocating today or we're simply reviewing. The fault is not in the folks that represent companies that are in other countries. You're not the problem. We're the problem. We're the problem in a direction and within the context that we're talking about. And how is this paid for? This is paid for by those folks who do pay taxes in this country. And it particularly hurts New Jersey, which is the second worst in the entire nation. I think we need to take a look at this. We need to look at this very, very, very carefully. When you look at what taxes are paid in the Netherlands or in Germany or in Japan, then you start to put things into context. And I want to ask you this question, Mr. Schoen. How does your VAT work on an everyday commerce situation in the Netherlands? How does that work? Tell us.
The VAT is a tax that is levied in every chain of a supply chain or a production chain to the ultimate customer. However, in every step of the chain, the input VAT can be deducted. And that's why it's so that in essence, only the value added will be taxed, and in essence, it will be paid ultimately by the consumer, by the end consumer.
Now, we don't have a value-added tax in the United States, do we?
No, you don't.
You do not. You know our economic situation in terms of our trade, our imbalances. Would you recommend that we take a look at a VAT in this country?
I would think there's nothing wrong at looking at any other tax, including VAT.
Thank you, Mr. Chairman.
Thank you.
Thank you.
To conclude today's questioning, Mrs. Black is recognized.
Thank you, Mr. Chairman, and thank all the panel members. I know it's been a long day for you. I sure appreciate your being here. Given that all of the G7 countries have adopted a territorial tax system, do you think that the United States companies will have more difficulty competing in the global marketplace if we continue to use the current worldwide tax system? And this
Yes.
would be for all the panelists.
Yes, I do. I believe that the world has changed, and unless the United States changes with it, the U.S. companies will become less competitive.
Mr. Schoen?
I cannot judge the U.S. side of, as there are so many elements that play a role here. But again, the Dutch experience was positive.
Thank you. Mr. Edge?
Tax, I don't think, is a driving factor. It's not the predominant reason why people do things. But it's a swing factor, and the fact that other jurisdictions have gone in that direction tells you something. Having said which, I think US companies compete pretty well at present in the arena that I'm in. But having gone through the UK process, I'm a big advocate of a territorial system.
Thank you.
Yeah, Germany didn't change the system, but I believe from comparing the two systems and being in Germany and in the United States, the territorial system is easier to deal with and should have less conflicts between taxpayer and the tax authorities.
Mr. Avellano?
As I said before, I don't think territoriality as narrowly defined here has anything to do with the competitiveness of U.S. multinationals.
Thank you. I yield back.
Well, I first want to thank the panel not only for your insight today, but your concise, clear answers. Frankly, a number of members had 2 and 3 rounds of questions with each member of the panel. That's very rare. So commend you very much, both for the knowledge you imparted, but also for the answers that you provided us. And also I would say, Mr. Thomas, looking at the relative compactness of the Japanese tax code, I don't know whether to be inspired or depressed. Either way, we have some work to do. With that, this meeting is adjourned.